Dear investor, global markets remain buoyant while India struggles and figures among the relatively weaker performers globally. We believe that following are the reasons for the same. Continuous currency depreciation. The USD has been weakening against a slew of currencies. The DXY, which measures the strength of the US dollar, has been weakening and is now under 100. Weakness in the USD is contributing to inflows into countries with strong currencies and supporting those markets. However, the Indian rupee is among the relatively weaker currencies globally and is weakening against the USD as well. Hence, our markets are not seeing the benefit of a weak USD. Currency depreciation may continue to be influenced by weak exports in high value added spaces due to high US duties. Momentum chasing. Many emerging markets are performing well while India has faced challenges. India is amongst the top allocation in an emerging market portfolio. As it happens in any portfolio, if one of the top allocations doesn't work, then the pressure to reallocate may increase to avoid underperformance, especially when other top allocations are doing well. This appears to be occurring and is contributing to continued selling. Relative valuations have improved but can be cheaper. While India has been amongst the weaker performing markets of the last 12 months and has seen relative valuations drop back within long period valuation range, low valuations could remain a consideration for long-term offshore investors. A more stable policy framework and lower taxation could be supportive. Lower presence of in-focus growth spaces such as AI. FPIs look at emerging markets for growth. Today's growth themes are largely led by the AI. India currently has limited listed exposure to strong AI plays. Money is hence flowing to markets that offer better exposure to these growth themes. One thing is leading to another. Negative FPI flows may be impacting growth spaces which are doing well globally, such as defense, new tech, EVs, renewables, etc. Strong fundraise from the market. The Indian market is witnessing an elevated momentum of fundraise from the market. Companies are raising money while PEs, early investors, and promoters are also selling. As a percentage of market cap, it is relatively high compared to several global markets. This fundraising momentum exceeds the inflow of new money, forcing investors to sell existing holdings to fund exposure to new entrants. This is causing a narrowing of market breadth. Reduced domestic HNI and retail interest. Domestic money has continued to come into funds. However, if we look at the data, there has been a moderation in retail money flow into the market. This may be due to low returns, selling to fund derivative losses, and the relatively strong performance of gold and silver drawing money away. What is expected to improve the situation going forward? Reemergence of earnings growth. Q2 saw corporate India deliver numbers above market expectations, and Q3 can be an encore. This could restore confidence in investors. Correction in valuations. Larger cap indices have moved up around 10% over the past 1 year with a commensurate change in earnings and have maintained valuations. However, the broader market has seen a better earnings growth and indices have performed relatively weaker, leading to a valuation correction. This correction is more pronounced in the high growth spaces. In some sense, high growth spaces appear relatively better valued. The valuation comfort may support performance once the market stabilizes. Currency stabilization. This may happen when we get a favorable trade deal with the West. If a deal with the US also emerges, it could influence sentiment. The US is one of the biggest allocators of money. Other markets have seen positive moves after deal with the US and we could see the same. Good deals with the West can start a virtuous cycle of the world taking note. This could potentially lead to the stabilization of the INR, allowing us to participate in global capital flows. The inflow of global capital may provide more confidence to domestic capital sitting on the fence to come in and influence the demand supply equation. This could result in our markets also participating in the rally seen across the globe. For growth investing, a lot of enablers already exist. Interest rates are relatively low in India and the West, Inflation is low and oil prices are low. Earnings momentum in the index constituents is relatively muted, while strong growth continues in growth spaces, and it can continue during this result season as well. Ultimately, as things fall into place, we do expect markets to follow earnings growth. The period till March 15 has historically proved to be a good entry point for investors. Most years have seen relatively strong performance in the next 9.5 months versus the first 2.5 months. Investors could use this insight to their advantage. Time for alpha. We believe that this period is a period which may offer alpha generation possibilities because growth quotient in the index in general and index heavyweights in particular has been weakening. At the same time, new growth areas have been emerging with new leaders. The old order is slowly giving way to the new. This is a combination that may be relevant for alpha-oriented strategies. However, over the past year, alpha generation has been weak and most of our older funds have lagged. Even over fiscal till date, our funds have lagged the index. This is because while structurally the alpha tailwinds are strong, yet over last 1 year there have been headwinds. Currency weakness has meant that offshore investors have been strong sellers and global growth themes have not manifested themselves in India to a meaningful extent. Global themes such as renewables, defense, and new tech did not manifest themselves in the country. Indian market has been delinked from global trends in 2025. Breadth of the market has remained relatively narrow for reasons discussed earlier. As time goes by, past growth themes can lose their zing and new themes can emerge. At Motilal, we have tried to incorporate new themes such as circular economy and EVs in our portfolios. At the same time, we have reduced exposure to spaces such as EMS and renewable energy to make space for newer spaces. Spaces which had done well and were facing valuation headwinds have also been pared down. We have increased exposure to select NBFCs and also included select mid-sized banks where growth quotient is relatively higher. New tech exposure has been increased. At the same time, overall market cap of the fund has seen an increase as we have tried to focus on relatively larger cap companies. While new themes can emerge, many of portfolio names have seen earnings growth and have seen a valuation correction. Moreover, some have adapted to benefit from new opportunities. We believe that some of these names may contribute to performance over the next period. While the headwinds can continue, we do believe that improvement should be around the corner and could coincide with currency stability and trade deals. Over the next 1 year, in the backdrop of prevailing growth factors such as low inflation and interest rates, as the headwinds sort themselves out over time, we think following spaces may have long period earnings growth potential. New tech on continued growth momentum as players substitute traditional ways, defense on sustained demand on account of higher threat perceptions globally, renewables on improved power demand as home air conditioning demand, data centers, and Make in India initiatives start growing. EVs as charging infra is rolled out and a critical mass of customers begins to adopt the technology. Circular economy participants as countries try to reduce environment impact and seek rare minerals. Capital market players on general market buoyancy, chemicals on improved sentiment towards commodities on lower Chinese export incentives, and fast growing NBFCs and banks could contribute to performance. While the world has celebrated high growth spaces in 2025 after a strong 2024, Indian high growth spaces were probably amongst the weaker performing asset class globally in 2025. Even if there is a reversion to mean, it could prove to be a year for alpha. Thank you, happy investing, and may the good times continue.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.